people focus at was the rental piece of it. But I'm going to break the myth for you right now. If you're looking online and you're looking at educators and you're watching all the influences that are out there in the real estate space that are selling programs, that are selling educational courses, they would lead you to believe that it is super easy. You make a shit ton of money, you become rich and wealthy pretty quickly. The truth is, that is not how it works. The rental piece of real estate is a very slow burn, all right? You might not be making a lot of cash flow at the beginning. You might not be making a lot of extra money. And if you're doing it right, any extra money that you make, you're going to be consistently investing that back into properties because your goal is, over the course of time, to create generational wealth. And that takes time. And just remember that it's a slow drip. So if you're going to get rich in real estate really quickly, buying rental properties is not necessarily the right way right at the beginning because it's going to take you a little bit longer to get to a financial peak and a financial plateau that you want to be at. So what I say is kind of learn everything. Learn how to flip, learn how to wholesale, learn how to keep rental properties. And at that point, then you know how to do everything. So you never have to turn down a deal, right? Like depending on where the numbers are at, you can figure out which route might be better for you. And we got some other YouTube videos that will be out there that will talk about the numbers and the breakdown and the performance and how do you decide if you flip, if you wholesale, or you hold a property. And I'll break that down in for another video for you guys, all right? But let's talk about some other general terms when you're getting started off. A lot of people have no idea what a cap rate is. A cap rate, like let's say you're looking at a property and it's being sold at a 7 cap, okay? All that means is that it has a 7% capitalization rate and that property, the way that it's being sold based on the financials currently, is that you should expect a 7% return on your investment, okay? Now, if you are looking to buy a cheaper property, then you want a higher cap rate, okay? If you're looking to buy a more expensive property, those cap rates are going to be down a little bit. And on the flip side, when you go sell a property, you want to sell a property at the lowest possible cap rate because that's the most expensive price that you can get. When you buy, we want to buy at the highest cap rate so that we can improve that property and we can get there. All right, so that's what cap rate is. If you're looking for money in real estate, a lot of things that we do when we flip properties or we buy discounted properties that normal traditional banks might not fund. We use what's called hard money. Hard money is non-traditional lenders, and you can find them in any area. Just go to Google and search up hard money lenders in your area. And these hard money lenders typically will give you anywhere from 75 to 90. And if you have some experience, you can even get all the way up to 100% of your purchase price. And what they do is they fund the deal quickly. It's not a full paper doc loan. So they're looking at the property. Is it going to perform? They're going to look at your credit score, make sure that you're okay. They're going to look at your experience. But hard money lenders are much easier to use to fund properties. So they're going to probably give you anywhere from 75 to 90%. And then they're going to give you 100% of the rehab money. So they're going to take, like, let's say it needs $100,000 in rehab. That closing time, they'll take $100,000 and they'll stick it into an escrow account. And then as you rehab the property, you'll request draws and they'll pay you back for the rehab that you've done. And then when you sell the property, you pay the money back, the hard money loan back, and you take the profits off of there. It's a very easy way to get into real estate without going to a traditional bank, because traditional banks are going to want all kinds of docs, all kinds of stuff from you. It's going to be a lot harder. Now, we also have what's called DSCR loans, which is a debt service coverage ratio loan. And what that is, that's a bank that is looking at the property's specific results, okay? They're not looking at just you and do you qualify as a loan person, but what they're going to look at is they're going to look at that property and they're going to say, does it meet the DSCR? Now, a lot of banks want 1.2 to 1.25. 1.25 is a pretty safe number. And they're going to say, does the income from this property cover at least 1.25% after everything is paid out, right? And that is what a debt service coverage ratio is. And they want to know that that property is going to be able to perform and you're going to be able to pay your mortgage and your bills and everything else. Okay? Pretty simple. Everybody knows what a real estate agent is. And if you're not a real estate agent, then you need to find one that you trust that is investor focused and understands how to put together a buy box for you to go looking for properties. You need to make sure that you have an home inspector that's on your team that you trust, that's working for you, that's not just working with the realtor or the lender. That they're going to go in and tell you what's wrong with the property, what's not wrong with the property, so you have an accurate input. You want to make sure that you reach out to a good loan officer, okay? Have a good bank that you establish a relationship with, a local credit union, a local regional bank, somebody that makes decisions in-house, because later on we're going to talk about cash out refinance. But you want to make sure that you have all of those people on your team. Make sure you have your hard money loan officers that are ready to go and ready to write deals for you. And most of the hard money lenders, you can go and get pre-approved for a certain number. That way, you know, when you find a property that hits the buy box that you've told that lender about that they've approved you for, all you got to do then is get the property verified and they'll be able to write that loan for you. It's usually very fast. I mean, I have hard money lenders that will fund a deal in less than 7 days. So very important for you to find hard money lenders. Now, cash out refinance, what does that mean? That just means that we buy a property discounted and then we fix it up and we put a renter in there. And at that point, we're able to go back to a regular bank and we're able to say, we want to do a cash out refinance. They send out an appraiser. That appraiser will say, yes, the ARV, which is the after repair value, is X amount of dollars. So let's say they say the ARV, the appraiser says this house is worth $100,000. That bank will allow you to take 75 to 80% out of that new appraisal price to get a new loan. So in this situation, let's say you get $75,000 out. They're going to pay off your hard money loan, or they're going to pay off cash that you used to buy that property. And then anything left after they've paid that out, that just goes in your pocket. And the beautiful thing about a cash out refinance is any money that you get off of that is not taxed. You don't have to claim it. It's not going to the IRS. So basically, a rule of thumb for all of us investors is at a very minimum, we want to be all into a property of 75% of the ARV. Now, I lower it down a little bit because I'm a little bit pickier with properties, and I want to be around 65, 70% of the ARV of a property. So I want to buy it at a discount, and then when I add in how much it's going to take me to rehab that all-in number and your soft holding costs like utility bills and alarms or, water bills, all that good stuff, that all-in number should be 75% or lower than what the after repair value is, that new appraisal amount, because that's going to allow you to successively get all of your money back out of that property, and you'll virtually have $0 in the game at that point. That's ARV. Now, those are some basic terms, right? I have a whole ebook that has all kinds of terms. It has everything you can imagine with real estate. But those are some pretty basic terms that you need to understand kind of right off the bat. Now, if you're asking for advice, how do I get started in real estate in 2025? This is what I would say to you. One, we need to be in the right mindset before we start into real estate or any business. And I could talk to you days and days about entrepreneurship and the different businesses. I'm a big proponent on buying existing businesses that already have clients, that already have consumers, that already have income coming in. But at the end of the day, real estate is pretty simple. You heard me talk earlier about getting your team ready. Get your team ready. And then what I want you to do is I want you to take a piece of paper out. I want you to write down everything that you spend out income-wise, everything that you spend out expense-wise. I want you to write down your income that comes in for the total month, and I want you to be very honest. If you know that you spend $3.97 at Starbucks every other day, put that in your expenses, because what we're trying to get to is I want to know what the leftover cash is, what we call the disposable income that you have left over every single month, because that tells me if you could afford an extra payment, right? So know what that number is. Once you get established with your lenders and all that good stuff, and you get approved, then you're ready to start looking at a property. But before you do any of that, I want you to take the time to go find as many podcasts that are legit podcasts about real estate. I want you to read as many real estate books as you can. I want you to, search and